Greetings. Welcome to our e-learning module on Nonprofit Accrual Accounting, a beginner's guide. In this session, we will explore the fundamentals of accrual accounting, how it differs from cash accounting, and why it's essential for nonprofit organizations. We will also cover key concepts like revenue recognition, expense matching, and financial reporting, helping you build a solid foundation for understanding nonprofit financials. Accrual accounting is a method that records income and expenses when they are earned or incurred, not when cash is received or paid. This approach aligns with two key principles: the revenue recognition principle, which ensures income is recorded when earned, and the matching principle, which ensures expenses are recorded when related revenues are earned. These principles provide a more accurate picture of a nonprofit's financial health. Nonprofits use accrual accounting because it is required by generally accepted accounting principles, ensuring compliance with established standards. This method provides a more accurate financial picture by matching income and expenses to the periods they occur, rather than when cash changes hands. Additionally, it helps nonprofits meet donor and grant reporting requirements, offering transparency and reliability in financial statements. GAAP, or Generally Accepted Accounting Principles, was created as a central response to the 1929 stock market crash, aimed at standardizing accounting practices and ensuring their honesty and integrity. For nonprofit organizations, adherence to GAAP is required to maintain transparency and accountability. By following these standards, nonprofits can maintain a sterling reputation with donors, grant makers, governments, and other key stakeholders, building trust and confidence in their financial practices. The accrual method offers several benefits over the cash method, providing a more accurate financial picture by recording income and expenses when they are earned or incurred, rather than when cash is exchanged. This method allows for better financial planning as it reflects to the true economic activity of the organization. On the other hand, the cash method is simpler, but can distort financial health by ignoring transactions that haven't yet involved cash. Accrual accounting gives a clearer view of long-term sustainability and performance. The two key concepts in accrual accounting are the revenue recognition principle and the matching principle. The revenue recognition principle states that income should be recorded when it is earned, not when payment is received, ensuring that financial reports reflect the true timing of revenue. The matching principle requires that expenses be recorded in the same period as the related revenue, giving a more accurate picture of profitability and aligning costs with income. Double entry accounting is a fundamental bookkeeping method where every financial transaction affects at least two different accounts with equal and opposite effects. This system satisfies the accounting equation assets equals liabilities plus equity. The golden rule is simple. For every debit entry, there must be an equal credit entry. This approach standardizes the accounting process, improves the accuracy of financial statements, and makes it easier to detect errors. All business transactions are recorded as either a debit or a credit, ensuring comprehensive and balanced financial records. Accrued revenue occurs when a service or product is provided but payment has not yet been received. For example, if an organization earns $500 in sales revenue, the adjusting entry would be debit accounts receivable $500 and credit sales revenue $500. Once the cash is received, another entry is made, debit cash $500 and credit accounts receivable $500, reflecting the collection of the amount owed and clearing the receivable from the books. The matching principle ensures that expenses are recorded in the same period as the related revenue, providing a more accurate picture of profitability. A visual representation of this concept shows the time period assumption, which aligns revenues and expenses to specific accounting periods. As revenue is recognized, the matching principle ensures that corresponding costs are also recorded, offering a clear view of how resources contribute to income during that time, resulting in an accurate financial reporting and performance evaluation. Let's look at an example of purchase and payment entries. When office supplies are purchased on credit for $50, the entry would be debit office supplies 50 and credit accounts payable 50. Once the payment is made, the entry would be debit accounts payable 50 and credit checking account 50, reflecting the payment made to settle the outstanding liability. Key concepts in accrual accounting include accrued income, which is revenue earned but not yet received, such as pledges or grant awards. Accrued expenses are costs incurred but not yet paid, like rent or wages. Deferred income refers to revenue received in advance but not yet earned, such as advance ticket sales. Prepaid expenses are payments made for future costs like annual services or insurance, ensuring that financial statements accurately reflect the timing of income and expenses. Understanding debits and credits is key to double entry accounting. For assets and expenses, debits increase balances while credits decrease them. Conversely, liabilities, equities, and revenue increase with credits and decrease with debits. In a debits and credits table, assets and expenses are debited to increase while liabilities, equity, and revenue are credited. This balanced approach ensures that every transaction is recorded correctly, maintaining the integrity of financial records and supporting accurate financial statements. This flowchart of debits and credits visually represents how each account type is affected by transactions. For assets and expenses, debits flow upward, increasing their balances, while credits flow downward, decreasing it. For liabilities, equity, and revenue, credits flow upward, increasing their balance, and debits flow downward, decreasing them. This visual flow helps clarify how transactions impact various accounts, ensuring a balanced accounting system where debits always equal credits. Accrual accounting offers several benefits, starting with financial accuracy by matching income and expenses to the periods they occur. This leads to enhanced decision-making as it provides a clearer picture of an organization's financial health. It also ensures compliance with accounting standards, promoting transparency in financial reporting. Finally, by offering a more accurate and honest view of financials, accrual accounting helps build trust with stakeholders, including donors, grantors, and investors. Financial statements in accrual accounting include 3 key reports. The statement of financial position, or balance sheet, provides a snapshot of assets, liabilities, and net assets at a specific point in time. Following the equation, assets equals liabilities plus net assets. The statement of activities, or income statement, tracks revenue and expenses over a period, showing changes in net assets. Lastly, the statement of cash flows reflects cash inflows and outflows, offering valuable insights into cash management and liquidity. Setting up accrual accounting for nonprofits begins with transitioning from the cash method to accrual, which involves recognizing income when earned and expenses when incurred. Next, create a chart of accounts tailored to the nonprofit's activities, ensuring clear categorization of assets, liabilities, revenues, and expenses. Finally, establish a system for tracking revenue and expenses accurately, aligning them with the periods in which they occur. This setup ensures transparency, compliance, and more accurate financial reporting for the organization. Let's look at some practical examples. First, for recognizing revenue, if a nonprofit receives $10,000 to be used next year, it would record the amount as deferred revenue until earned in the following period. For recording expenses, if an electricity bill for $2,000 is incurred in December but paid in January, the expense would be recorded in December under accrual accounting. Lastly, for prepaid expenses, if $6,000 is paid for a 1-year insurance policy, the payment would be recorded as a prepaid expense, with $500 recognized as an expense each month. An example template for prepaid reconciliation includes columns for expenses and rows for monthly amortization. Each month, a portion of the prepaid expense is recognized as an expense, with the corresponding amount deducted from the prepaid balance. The template tracks this monthly allocation, ensuring that the total prepaid balance decreases over time as the expense is recognized. This helps maintain accurate records and ensures that prepaid expenses are properly amortized throughout the coverage period. Implementing accrual accounting comes with challenges such as complexity in tracking revenue and expenses, staff training needs, and the effort required for the initial transition. To overcome these, invest in accounting software designed for nonprofits like QuickBooks, Nonprofit, or Sage Intacct to streamline processes. Provide regular training for staff and volunteers to ensure they are up to speed, and consider working with financial consultants for expert guidance throughout the transition and implementation phases. Accrual accounting provides a comprehensive financial picture, giving organizations a clearer view of their financial health. It enhances credibility with stakeholders by ensuring transparency and supporting compliance with accounting standards. This method also enables better decision-making through more accurate financial data. By investing in the right tools and providing proper training, nonprofits can ensure the success of their accrual accounting practices and build long-term financial stability. Thank you all for viewing this e-learning module. Have a wonderful day.